Hi there, my name is Philip Idson. I want to welcome you to the Art of Procurement podcast, the podcast that helps you, a forward-thinking procurement professional, position yourself and your team to proactively take advantage of the revolution that's taking place in procurement today. By interviewing industry trailblazers and sharing insights from our own experiences, my team and I pull back the curtain and shine a light on the strategies, tactics, and tools that procurement teams are using to elevate their impact. And today on the podcast, we're going to do something a little bit different. You may or you may not know that my partner at AOP, Kelly Barner, also hosts a weekly podcast called Dial P for Procurement. It's a completely different format from AOP, and I have to say, although I know I may be biased, I really love it. Kelly does an amazing job with each episode. Dial P for Procurement, it tells stories. So Kelly picks a story each week that takes the listener deep into a particular topic. It's either related to supply chain or procurement, or that takes a wider lens at a subject that really will help you in your career. The podcast is also part of the LinkedIn Presents network. It's a really limited number of podcasts globally. I think it's under 20 that LinkedIn invited to be part of their own podcast program. Now, each episode is typically 20 to 25 minutes in length, and you can listen wherever you get your podcasts or by going to artofprocurement.com/dialp. And the episode that I thought I'd share today tells the story of when Kraft Heinz fell foul of the SEC for the way that they secured and reported on supplier cost savings. The episode is called A Gap in Judgement at Kraft Heinz. So with all that said, I'm going to let Kelly take it from here.
I recently got a notice in the mail from the KHC Fair Fund. KHC, in this case, stands for Kraft Heinz Company. And getting that letter reminded me of one of the most dramatic, highest profile procurement scandals I've ever encountered. And it is a story that bears retelling. So here we go. In this episode of Dial P for Procurement, I'll explain what happened at Kraft Heinz when procurement was expected to hit aggressive savings goals post-merger. I'll point out the internal oversight breakdowns that allowed this trouble to continue for far longer than should have been possible. And we'll review the fallout, which, as we see from this letter I just received, continues to this day. So we start this story back in 2015 with the merger of Kraft and Heinz. This $49 billion merger was the brainchild of investment fund 3G and Berkshire Hathaway. They bought Kraft Foods to merge it with the H.J. Heinz Company. Their investments in Heinz were starting to lose steam and returns were falling off. The reality is that there were no more efficiencies to work out. So they made the decision that it was better to buy another food company and start the efficiency cycle all over. Based on sales, this merger created the 5th largest food company in the world and the 3rd largest in the United States. Just as they expected in the ramp-up, operational efficiencies were deemed to be a key driver in making the transaction happen, mostly through eliminating redundancies and having more volume to leverage. As you would imagine, given that strategy, procurement was right at the heart of the value proposition, and they were looked at to help grow the combined company's net profit. Now, Klaus Hoffmann was the chief procurement officer. He had been with Heinz in advance of the merger. And based on executive guidance, he set incredibly tough performance targets for the procurement team. They set off immediately, negotiating more favorable contracts and terms with their suppliers based on this new combined purchase volume. Once all of the low-hanging fruit had been managed, the bar wasn't lowered and the pressure didn't come off. Now, because of all this pressure, and on the surface, Hoffmann and his team looked wildly successful. Kraft Heinz issued new debt based on the success of the program, and Hoffmann was given cash and stock bonuses as rewards for hitting his targets. In 2017, a couple of conditions aligned to sort of change the playing field. Foreign exchange rates became less favorable, and the cost of ingredients or input prices for Kraft Heinz started to inflate, becoming problematic. Now, at this point, all of the synergies had been worked through, but the procurement team was still facing a $10 million gap in their savings goal. And it was up to them to figure out where that money was going to come from. Now, the CPO didn't back down, and part of this is connected to the company's culture. The bonus structure that was in place incentivized procurement and operations, which is where procurement reported into, to show the highest possible cost savings. Now, this culture also led to inexperienced individuals receiving promotions because the willingness to show the largest amount of savings sort of tipped the scales in the favor of the boldest team members. The chaos created by the disruption of the merger and that corporate culture became a perfect storm. Many of the business unit heads that had been in place before the two companies merged either were put into different roles or simply moved on from the company. Those positions were filled with young, ambitious employees, and the company promised them, quote, Wall Street money if they were able to hit their goals. Quick promotions continued. And in fact, in 2017, David Knopf became the chief financial officer at age 29. Now, I'm not trying to be ageist, but 29 seems really young to be the chief financial officer at the fifth largest food company in the world. Bad things were starting to happen under this pressure, and there really wasn't anyone keeping an eye out. Now, this pressure to perform was not just coming from inside of the company. It was coming from those investors too. 3G, the investment firm that along with Berkshire Hathaway combined the two companies, is known for being ruthless in its approach to private equity investment. They use a zero-based budgeting methodology, meaning that every single expense must be justified. When we benchmark against other companies in the food industry, at that time, for every dollar of sales, the food industry was earning 15 cents. But after 18 months of management under this 3G zero-based budgeting model, most of their companies earn 26 cents for every dollar. So it's an absolutely cutthroat, intense kind of pricing structure. Now, when there's a will to succeed, there's a way. And so those procurement employees started finding, let's call it, creative ways to artificially realize cost reductions. They were going to hit those targets. And there were 3 different techniques that they tended to use. One was a prebate, so signing a long-term contract with a discount applied up front that could be claimed as savings. Another is a clawback transaction, where the supplier gives the buyer a short-term cash payment in exchange for a long-term price increase. And then the third technique is price phasing, where the buyer receives reduced pricing for a short period of time that is then offset later by pre-agreed upon future price increases. As we would learn later, the SEC identified 59 of these creative transactions that took place. Part of the difficulty here, and this is where procurement often struggles to justify and document savings internally, but depending on how the company handles that from a reporting standpoint, this is where we come to the question of GAAP compliance. GAAP is GAAP, Generally Accepted Accounting Principles. And if that sounds kind of huggy-fuzzy, don't be fooled. It's a lot more formal than generally accepted, makes the practices sound. One of the requirements, at least as far as savings are concerned, is that you have to recognize those savings after the associated commitments have been fulfilled. So an example that comes to mind around this is a capital investment. If you build a building or if you buy a piece of equipment that has an X year depreciation schedule, you're supposed to distribute the recognition of the savings on the same schedule as you depreciate the asset. There are rules for understanding where the savings can be recognized and when. Kraft Heinz Procurement was trading future liabilities for short-term savings. And it wasn't the savings themselves that made this an SEC issue. It was actually the failure to recognize and declare those future liabilities. So accounting needed to let shareholders and stockholders know that these future commitments or liabilities had been created in exchange for the short-term savings. Because without that information, investors were making decisions based on incorrect information. Kraft Heinz ended up recognizing unearned discounts from suppliers and maintaining false and misleading supplier contracts. That inappropriately reduced the company's cost of goods sold. They then publicly reported on the false savings, which resulted in an artificially inflated EBITDA. So that's earnings before interest, taxes, depreciation, and amortization. If everything had been done by the book, Kraft Heinz's cost of goods sold during the period in question would have been $50 million higher than was reported in its public financial statements. Now, that's a lot of accounting gobbledygook, right? So let me give you a couple of stories to give you a sense of how this all actually worked. Now, this is all according to the SEC. In 2017, Kraft Heinz Procurement negotiated a $2 million prebate from a sugar supplier in exchange for a 3-year contract. They committed to extending an existing contract and also to making future sugar purchases in a certain volume. Kraft Heinz had to return that $2 million prebate back to the supplier by agreeing to pay higher prices for sugar during that 3-year contract extension. So in effect, the agreement did not produce any cost savings, but the company still recognized the full cost savings in August of 2017. This sounds like an absolutely wild idea, and I can't imagine trying this. But perhaps they were bold enough to do it in 2017 because it had worked in the past. Again, according to the SEC, all of these types of creative transactions predated the merger. CPO Klaus Hoffman had been at Heinz. In 2015, he negotiated a $3.5 million prebate in exchange for a new 3-year contract. Now, when the merger took place and people started looking into the details, they had to reword the contract to make sure that the savings got to stay where the company wanted them to be. And so that prebate was positioned as a non-refundable payment because that allowed 100% of the $3.5 million, not the third that would happen current year. That's when the savings got to hit in the contract year. Now, I guess it was nice attention to detail to update the contract wording, but following an illegal contract to the letter doesn't actually make the resulting actions legal. So I'm not sure how it came to their attention, but in October of 2018, the SEC began their investigation into these practices at Kraft Heinz. The news wasn't made public until early 2019. That's when Kraft Heinz both announced a $10 billion loss for the previous year and admitted that the SEC probe was ongoing. By May of 2019, Kraft Heinz announced that they would restate 2 years and 9 months of financial disclosures. So this covered all of their activity in 2016, all of 2017, and the first 9 months of 2018. The really funny thing about this is that the company stated in June, when they were making these explanations, that no misconduct had been found on the part of senior management, which is kind of odd because both the chief operating officer and chief procurement officer had been involved. Now, maybe they didn't know the involvement of these two individuals, or just thinking about this with procurement's luck, they didn't think of the chief procurement officer as a senior executive. That is just our luck. The cumulative adjustment to earnings from that 2015 to 2018 period represented less than 1% of Kraft Heinz overall net income. The understatement of product cost was about $208 million across 300 total transactions. But the fact that it had happened was more important than the numbers. Now, one of the questions it seems fair to ask is why these practices weren't caught and stopped by anyone internally. And this comes down to sort of 3 functional teams that were related in some way. One was operations, where procurement reported in. One, of course, was procurement directly. And the third was the legal staff that were supporting procurement. So let's go back to operations. According to news coverage after the fact, there were many warning signs that expenses were being managed through manipulated agreements with suppliers. Rather than addressing those risks, the chief operating officer, quote, pressured the procurement division to deliver against unrealistic savings targets. Now, that chief operating officer, Pellisone, he also approved the company's financial statements. So he was both in a position to know what was going on, know what was wrong, and also to still approve the financial statements for external distribution. As we've said, the chief procurement officer was involved too. Hoffman approved several improper supplier contracts, and he used those to further the misconduct despite, again, numerous warning signs that procurement employees were circumventing internal controls. As with the chief operating officer, he certified the accuracy and completeness of the procurement division's financial statements, even though he knew this misconduct was occurring. And then finally, legal. How could legal let this happen? Well, they were understaffed, they were under-resourced, and their internal performance metrics and compensation were tied to helping procurement hit their targets around reducing costs. So this is essentially a situation where you set up unrealistic targets, incentivized everyone to hit them, and then gave them absolutely no reason to step up and say that the wrong thing was happening. You get what you incentivize. According to the SEC, Kraft violated 3 different regulations. There were negligence-based anti-fraud provisions of the Securities Act. There was the periodic and current reporting requirements of the Exchange Act, and the books and records and internal accounting controls provisions covered under the Exchange Act. Now, that all sounds really negative. So just to look on the bright side, because we like to be positive when we can, Kraft Heinz did win a bad buying award from author Peter Smith in 2021. The fallout from all of this happening affected the company as well as employees. Kraft Heinz stock price declined, their deteriorating financial performance ultimately led to the loss of $13 billion in market value just during calendar year 2019. And the company was issued $62 million in fines. That's what that letter was about that I received. That $62 million is being distributed to eligible shareholders through notifications like the one I received. Compensation will ultimately be calculated based on the number of shares each person held, the exact dates those shares were held, and the total number of eligible claims that are submitted. Now, within procurement, there were roughly a dozen employees reprimanded, up to and including termination. Klaus Hoffmann, the CPO, was issued $100,000 in fines, and truthfully, that was probably a fraction of the value of the benefits he received. He was also barred from serving as an officer or director of a public company for 5 years. Another $300,000 in fines were issued against Chief Operating Officer Eduardo Pellisson. In addition, he had to pay back $14,000 in interest. Both of these executives were former executives at Kraft Heinz by the time the SEC assessed those fines. There were press releases. They, left to pursue other opportunities or left to spend more time with their families, as it were. And the fines that they paid were civil penalties. Neither one of them had to admit any wrongdoing. In fact, if I am looking at the LinkedIn profile of the right Klaus Hoffmann, former CPO at Kraft Heinz, he claims to be a highly experienced global chief procurement officer with a proven track record of setting and delivering against aggressive targets, and also having built one of the best-in-class center-led procurement functions, regarded as the benchmark in the FMCG industry, and has consistently driven top and bottom line results well ahead of the industry. Now, if you take out the best-in-class part, that's not entirely wrong. He did deliver against aggressive targets and drive top and bottom line results well ahead of the industry. Just don't ask how. Now, there was executive turnover as well. CEO Bernardo Hees resigned in 2019, about 5 months after the accounting scandal was revealed. I'd be hard-pressed to think there wasn't a connection there. In April of 2019, it was announced that Miguel Patricio, former chief marketing officer at InBev, would be replacing him as the CEO of Kraft Heinz. And Miguel is still in place. That same year, Kraft Heinz appointed a new chief procurement officer as well, Marcus Eloy Lima. He had been the vice president of procurement at AB InBev. About a year after stepping into the role, he announced the start of a broad transformation effort, including everything from changes in manufacturing strategy to increased visibility. According to a Supply Chain Dive article from 2020, procurement still reports to operations, and they are now centralizing their formerly fragmented indirect spend management. Beyond cost savings, Kraft Heinz also started to pay more attention to their balance sheet. They paid down their debt substantially, and as a result, they are not being impacted as much as other companies by today's high interest rates. So, what are the key takeaways from this story? First of all, there is no such thing as a shortcut. Procurement has to understand the financial and legal implications of playing fast and loose with savings calculations. KPIs and performance metrics, be damned. If you have to break the law in order to hit your savings targets, something is very wrong. And also, culture matters, both good culture and bad culture. There were multiple points of failure. There were multiple opportunities for this practice to be stopped. And no one stepped up and did it. And of course, even if it weren't covered as part of company culture, governance is important. There were internal controls that should have stopped this just as much as external perceptions. And unfortunately, any of the people that were in a position to have the information to know what was happening did not use that information to do the right thing. So for anybody that wants to say that procurement is a dull place to work, I challenge that. And for the record, you don't have to break the law for it to be an exciting and rewarding place to work.
If this episode struck a chord with you, please do send it to somebody. We grow here at Art of Procurement through word of mouth, and that would be really appreciated. You can also support us by giving us a thumbs up, a star rating, or a review wherever you listen to your podcasts. Since 2015, we've built the world's largest free resource for procurement professionals looking to elevate their impact. Our resources span podcasts like this, videos, blog posts, papers, and events. To join us on the inside and to ensure you never miss an episode, a webinar, event, or a post, please do subscribe to our weekly newsletter, This Week in Procurement. You can do that at artofprocurement.com/subscribe. That's artofprocurement.com/subscribe. Thank you for joining us today, and I look forward to seeing you again soon.